As you can tell by the title, we got a bit of a different but special one today. I've had this saved in the locker for a while for something like near the end of the bull market, but there are some important messages I want to get across well before then, leading to me coming out with this today. This topic or series won't be a one-off, however. Today will sort of be the intro with a few examples, but every once in a while I'll give updates on new exciting products this can apply to. We'll be talking about probably one of my favorite things in finance, that of course being yield, and options of how you can possibly literally retire with not that much money. If you're excited, make sure you're subscribed for more content like this. I genuinely just want to provide different pieces of information that'll help you in your overall crypto journey. Also, if you somehow haven't already signed up to the Fair Desk crypto exchange with link in description, the best non-KYC non-VPN exchange that can be used by anyone regardless if you're in the US, Canada, or any other restricted nations. Plus, with that link you'll get the lowest futures trading fees of any exchange, and up to 100k in sign-up bonuses. When it comes to the long-term crypto thesis, I don't know what's what in the future. I'm just here to milk every cycle as much as possible for gains that you cannot get anywhere else. That said, there are a couple things that I'm bullish on in the long-term trajectory of crypto. First and foremost, of course, being Bitcoin, the best denomination of digital energy, and among other things, being DeFi. If you're unaware, in traditional finance and lending and borrowing there is a lot of complications, counterparty risks, fees, and just a headache overall. DeFi in a lot of ways eliminates this, and furthermore expands your exposure to liquidity from what perhaps could have been confined to as little as a single municipality to going global in a sense. And yes, what you're all probably thinking, the yields that can and have been offered by products across the years is far more intriguing than TradeFi can come close to. No worries about borrowers running off, no middleman, no huge fees, just an algorithm between you and someone on the other side of the world with as much size as you'd like. This all, of course, is quite the arbitrary way to look at DeFi and other ways to garner yield in the crypto space, but the point is the prospect is still very exciting. You got a lot of people on the other side saying they'd never trust any of these applications, and they'd much rather opt for the safe, clean 3 to 5% yield offered from other agencies like the UST Bill's different high-yield savings accounts. You get the idea. I 100% agree, but the intention is that the more and more we learn from the mistakes of things like Terra Luna and the other crazy DeFi yield farms and arbitrages and inflationary mechanisms and all the other brutal mistakes we made, the more we improve, to where in my opinion eventually we will get concrete proven apparatuses that do in fact yield a safe 10, 20, 30% yield. Of course, we'll always have some risk no matter what, but no one's exactly claiming risk-free either. Even UST bills aren't risk-free. Now yes, they are backed by the US, and no, I don't think we'll ever get a DeFi product that'll elicit less risk than that. But day by day it's getting better and better. Even on a personal level, seeing how far we've come these last 4 or 5 years has been astonishing. I can only imagine another 5 or 10. This is why I often bring up the importance of fleshing out size. How? Because we're entering this world of AI replacing everything and hedges to that like a BTC and whatnot. Having a little bit of money to play in that realm will put you leaps and bounds ahead of the average Joe. So if this cycle you turn 50,000 into 300, but we're hoping for over 500, take that 300 every single time. The way that 300,000 would accumulate over liquidity cycles will probably be enough to break you out of that middle class phase. Instead of trying to do that all at one go in one cycle being what most people try to do, imagine a 20% yield on 300,000. Is that not an extra income of the average US salary? Like I said, we've still a long ways to go, but we have come quite far up to this moment. I will now be discussing different yield products that I think are cool and promising. Please understand, by no means are any of these an endorsement. This is not a sponsor, and most importantly, I am not advocating you to put a single dime into anything I'm about to mention. Instead, this is all for your knowledge. You can do whatever you want with the information, and if you were considering to put an amount of capital into any of these, make sure to watch the whole way through, because I have some extremely important tips that can quite literally save your capital. First up, we got cega. So cega is quite unique in how it offers yield by leveraging the power of options. No, don't worry, you won't have to be doing any options trading per se. It's confined in a very structured and simplistic manner, where all risks and yields and time components are well laid out beforehand, where your decision at that point is to dictate if you want to partake or not. They offer an array of products, but we'll start with their most popular one called Cruise Control with 10 million in TVL, as explaining this will give you an idea of what this whole thing is about. We'll come back to the yield, but pay more attention to this first, how the underlying assets are both Bitcoin and Ethereum. and how the downside protection you get is 90%. USDC is the working asset, where we're using a fixed coupon note and options play with bond-like characteristics. They have a good detailed description breaking this down, but the main gist is this. Let's say you put up 100,000 USDC. The tenor of how long your money will be held is 27 days. Your payout will depend on what happens during that timeline, where the main thing you'd want to avoid is having something called a knock-in event, which can be described as follows. You enter day 1 of the contract with ETH at 3,500 and Bitcoin at 65,000, as remember these two assets are the underlying coins. If at any time they go down by more than 90%, being the knock-in barrier for cruise control, you will be penalized. In other words, let's say if Bitcoin goes down to 7,000 or if ETH goes down to 300 within the next 27 days, you will lose a substantial chunk of your 100,000 USDC. Now obviously if that were to occur we'd have much bigger issues at hand, but that's the idea. There's also the scenario of let's say Bitcoin does go down to 7,000, but then rebounds back above it before day 27. You'll still lose capital as a knock-in did occur, but you won't lose as much. But in the scenario that Bitcoin or ETH do not go down 90%, let's even say they go down 80%, you'll make whatever the current market makers are offering, which is an 18.4% APY, or a return of around 1250 USDC on that 100 after the 27 days. In terms of risk, cega has them all laid out. Obviously the possibility of knock-ins is the biggest tangible risk, but we do know that having 90% drawdowns on BTC or ETH pretty much doesn't occur in recent history. Even from the very top of that 2021 bull market to the bottom of 22, BTC went down 77% and ETH 82%. But in terms of other risks, we got the one which applies to every DeFi application, being smart contracts. Cega does say they run audits, and by which firms. The additional risk, however, has to do with market makers not being able to pay back depositors due to a default, where there is not much you yourself can do about this. But Cega does say they have extremely strict guidelines in who can and can't be a market maker, with many credentials needing to be in place, where they're also constantly assessing balance sheets. Cruise control is the main product Cega offers, but there's others too. I highly recommend checking them all out. I really like how understandable they've made all the details. Some products give huge returns, 30, 50, 70% APYs, but those all obviously come with different risks. Next up we got the idea of liquidity provider tokens. Now these are also fantastic, as to me they perhaps best reflect how real yield is attained. We'll take the JLP liquidity token of the Jupiter platform as our example. So Jupiter is the biggest aggregator on Sol, acting as the bridge for getting you the best deals across the Solana DeFi space. Jupiter is a monster, we should be well aware of this, but it's the JLP token that fuels so many of its different trading types. Now JLP, the Jupiter liquidity provider token, is not like any other crypto token. Think of it instead like an empty vessel acting as a basket with the following crypto backing it: Solana, ETH, BTC, USDC, and Tether. We can see the average weighting for how much of these crypto make up a portion of JLP. And so the price of JLP can go up or down depending on how these assets trend. But as you can imagine, given that there's 2 stable coins involved and 3 of the biggest assets, the volatility for JLP is actually pretty confined. But if there were a scenario where we get a huge red day in the markets where all 3 of these go down substantially, JLP would also take quite the hit. The yield part of the equation is that with JLP, since you're providing liquidity, you're in a way the counterparty to any trades taken on the platform. So technically the JLP pool could get drained substantially if traders keep taking liquidity from it for their own trades. But based on the idea that most traders are losers, in the long run you should be the one taking their liquidity. So in a way you're acting as the casino here, banking on the idea that the house always wins. 75% of the fees generated are added back to JLP. And right now, based on the earnings, JLP holders are getting a 78% APY from nothing but pure cold real yield. That's quite the percentage. And on top of that, given that we're in a bull market, the JLP token price has been gaining even more value. Starting this year, the price of JLP was $1.81. Right now it's $2.84. That's over a 150% return, and it's only been half a year. You're outperforming many altcoins with a simple DeFi product. But as always, it's not all sunshine and rainbows. Like I said, when the markets tank, JLP will take a big hit. So let's say you cash out at the end of this bull market at the top and throw it into JLP. Well, as we get into the bear, expect 60 to 80% corrections on BTC, ETH, and Sol. So even if you're getting yield, the index assets are getting crushed, and so is JLP. And about that APY, It's only this high as long as Sol and Jupiter are getting used. As you can imagine, we won't get anywhere near the same usage in the bear, meaning less fees and less yield. Furthermore, like I said, you're the house. There could be events where you get absolutely drained. For example, if we get a Terra Luna type event again where the coin is programmed to go to zero, that's a very easy trade that would result in a huge loss of the liquidity pool. But nonetheless, everything I just said about JLP and other liquidity provider tokens certainly isn't a step in the wrong direction and is very promising. Another example of one is GLP, the liquidity provider token for the decentralized exchange GMX. I bring this one up because it has a bit more longevity to it. It's been around for just under 2 years now and zero problems with the yield. I do want to point out, however, that the average yields that we were getting from GLP have went down. For a while there it was consistently over 20%, as much as 30% on average, but as of late it's been hovering around 10. Not an outright risk, but this shows how if the product stops getting used as much, in this case being GMX, then fees will also subside. So don't just expect a JLP to give you a solid 60% across the year every year. HLP of HMX is another one, but overall LP tokens are a great option. And then we got something like Ethena, where with USDE we collect the funding fees from the opening of the hedge delta neutral short positions to the market going long. Since its genesis, I'd say on average there's been about a 20% yield. Now remember, during the bear a lot of people won't be going long, so I don't expect yields to stabilize at very high marks. But even year-round I think an expectation of 10 to 20% is quite fair. Competitors like Asymmetry Finance are also soon going to be coming out, and I expect many others too. Point is, this synthetic dollar narrative is going strong, and I think in the long term could work. Before you get excited though, I do want to make one thing clear. Be extremely careful of when you allocate into any DeFi products, as that is also a risk. The bull market to bear market transition is when most deleveraging occurs. This is the most likely time period that if something were to blow up, it'd happen here. Therefore, I'd strongly suggest not partaking in any crypto plays at the peak of the bull. I would say let the transition take place, let whatever needs to blow up do so, and once the calm after that storm arrives in the bear, that is where I'd look to allocate. But there you have it. TLDR DeFi is improving every year. These opportunities will become more abundant and better. This video just showed a couple examples, and I'd hate to not be involved in the future. Sign up to the Fair Desk Crypto Exchange for all your trading needs. Like and subscribe for more content like this, and I will see you in the next one.